Hey, my name is Josh Rosenthal from C-Level Insights and clevelinsights.com. We've been working through the big three financial statements, the profit and loss, the balance sheet, and the statement of cash flows. I think that you are an entrepreneur who is interested in finance. I don't think that you're a finance person interested in finance because I think you'd find this unsatisfying. I'm trying to help entrepreneurs understand how cash moves through their business so that they can keep their dream alive. Not that financial people don't have dreams, I think they do, and that's fine, but you're the one who's out there trying to make it go. And if cash runs out, then your dream is gone. For a finance person, if cash runs out, they go find another job where they can manage cash, where they can manage finance. And that is perfectly acceptable, but I think you are trying to keep cash in the bank. So that's why we're working through these big three. If you already feel like you have your mind wrapped around them, that's fine. Please still hang with me because we're developing a common language with one another so that when we talk about other things later, like ratios that we're looking at, like things that we've learned in the profit and loss, like variable costs, all this sort of stuff, I'm trying to develop a common language with you so we can go do the fun stuff. Keep cash in the bank so that you can grow, so that you can take a vacation finally. I know some business owners who've been 5 years without even taking a day off. I have one client who literally works 13 hours a day, 7 days a week. This is a path to you finding freedom and growing your company. So today we're going to talk about the statement of cash flow. Shorthand is SCF. There's three main sections to it. And ultimately what the statement of cash flows is trying to help you figure out is how much cash you have in the bank and where it came from. So we want it to come from operations. So that's the first section. In operations, this is that profit and loss, essentially. This is what comes out of that. So we had that revenue piece that went into the variable cost piece, that then went down to your fixed cost, and out of that came your net income, or what we also call bottom line. So we think, hey, some of your cash came from your bottom line. And even above that, we have to start with your bank balance. So this is what you have up here. So you have that much money, and then you do some good stuff, hopefully, in your business, and you throw off some profit, and there's some cash that goes out there, and then you build on that. Next thing that happens is that cash comes from investing. So what are the things that you're investing in or money that's come back from that? And that is what happens in this space that is your investing area. So if you're investing in, I use coffee as the example because that's where I come from, that's where I cut my teeth as an entrepreneur with La Barba Coffee. So if I bought a new roaster, I've invested in that. That's $100,000. That's where some of my cash is gone. A lot of the cash is gone oftentimes. So yeah, your second section, it goes through that grid of what have you been investing in. And finally, the last grid here is this financing piece where we're looking at where did the money come from for me to pay for the roaster. So maybe I took on equity, maybe we diluted, maybe we felt like the coffee roaster was so important that we diluted our shares, created some new shares, and then sold them to somebody so that we could then buy half of the roaster. And maybe the rest of it came from some version of an SBA. So then we have 50,000 here. So this is where our money came from. This is all good. All this stuff here is super important. We have to be doing these things. This is great. But in the end, a successful company isn't getting all of its money from financing and investing. A successful company is one that's ultimately throwing off profit. Even beyond that, a successful company is one that's generating cash. So the reason that profit doesn't always equal cash is because out of cash or out of profit, you have to be servicing debt. And sometimes your debt is really high, and sometimes debt is prohibitively high to where you can't generate enough cash to pay debt, in which case you have to go down into these areas to generate it. So what comes out the bottom is either your cash increase or your cash decrease. And so maybe if you had good operations and you had a lot of money here, and then you had to lose money here, this 100 grand, but then you brought in another 100 grand here. In the end, let's say maybe your opening balance was X dollars, maybe good operations, you had XX plus, $200. This is a statement of cash flow. What we're trying to look at is how money comes into your business, how it goes out. Sometimes it comes in one way, goes out another way, but what we really want to see it coming in as and building is through operations. You don't want to keep taking on debt in order to build cash, obviously. You don't want to keep diluting and taking on equity. You want to be operating a good business that's throwing off good cash. And the statement of cash flows is where we go to really understand how your business is doing. My name is Josh Rosendahl from C-Level Insights and C-levelinsights.com. We'll see you next time.